Okay, let's unpack this. We're talking about a company whose products, I mean, they touch billions of lives every single day.
Yeah, search, video, maps, the OS in your pocket, probably.
Exactly. We're diving deep into Alphabet, which is, Google's parent company. And specifically, we're using this stack of analysis, research, and notes that you provided us.
That's right. And the goal here, our mission for this deep dive, is really to sift through all your material. We want to pull out the really crucial insights.
So understanding the core business quality.
Yeah, the quality, its competitive advantages, the moats, as people call them, its financial health, the big risks it's facing.
And that key question, right? Price versus value, based only on what you gave us.
Exactly. Think of it as maybe a shortcut to getting really well informed on this pretty complex giant.
All right, let's jump right in. First thing, how does this machine actually make its money? And, why is it just so dominant? Your sources are pretty clear on this.
Oh, absolutely. The core engine, no surprise, is advertising, specifically through Google services.
Right.
And if you break down the 2023 numbers from your sources, I mean, it really tells the story. Google search and their other properties, that's the powerhouse.
Pulling in how much?
A staggering $175.03 billion just from ads. That's, where the lion's share comes from.
And it's not just search, though. YouTube ads were another huge piece.
Yep, $31.51 billion in 2023. And don't forget the Google network ads on other sites and apps. Another $31.31 billion there.
Okay, so ads are dominant, but there's other stuff within Google services, too.
Right, the non-advertising revenue. Think Pixel phones, Nest devices, the Play Store, YouTube subscriptions, that kind of thing.
And that added up.
Added up to $34.69 billion in 2023. Still significant.
Now, advertising's the core, but your sources also point to Google Cloud as the growth engine.
Exactly. That's their enterprise stuff, GCP, Google Workspace.
And the revenue there.
For 2023, it was $33.09 billion. But here's the really key point your sources highlighted.
What's that?
Google Cloud actually hit operating profitability in 2023.
Okay. That is significant because it was burning cash for a long time, wasn't it?
For years. It was a major investment, a drag on overall profits.
Yeah.
So seeing it turn profitable, standing on its own financially, that's a big milestone.
Got it. And then beyond the core and cloud, there are the other bets.
Yeah, the Moonshots, Waymo, self-driving cars, Verily in life sciences, that kind of ambitious long-term stuff.
And the numbers there reflect that, I assume.
Totally. Still very early stage.
Yeah.
Your sources show only $1.53 billion in revenue for 2023. And, they typically run at an operating loss. Lots of R&D spending.
Okay. So pulling it all together for 2023, total picture.
Total revenues hit $307.39 billion. Operating income, a massive $84.29 billion.
Wow.
The profitability, especially from search, is just incredible. And now cloud is starting to contribute to that operating profit, too.
And why is this model so durable? Your sources seem pretty confident it's built to last.
Well, several reasons. You've got persistent human needs, right? Finding info, being entertained. That's not going away.
True.
Then there's the huge shift of ad money to digital. That's a massive tailwind. Plus, those powerful network effects across their platforms.
We'll get into those.
And frankly, just habit. Billions of people are just used to using Google products every day.
Right, which brings us neatly to how they defend against competitors. The moats.
Yeah, the competitive fortress. Your sources point to two main ones: intangible assets and network effects.
Okay. Intangible assets first. What does that cover?
It's things like the Google brand itself. I mean, people Google things, right? A verb.
Can't get much more intangible power than that.
Exactly. Then there's YouTube's dominance in video, Android being the world's biggest mobile OS, and of course their huge portfolio of patents and tech search algorithms, AI, ad systems, cloud tech. It's vast.
Okay. But the network effects, that sounds like where the real magic happens.
It really is fascinating. Your sources show this compounding power. Take search, for example.
Right.
More users mean more data. More data makes the algorithms and AI better. Better AI means better search results.
Which attracts more users.
Exactly. And more users attract more advertisers. It just keeps feeding itself, getting stronger and stronger.
And you see the same thing with YouTube.
Pretty much. More viewers attract more creators. More creators make more content. More content attracts, you guessed it, more viewers.
And the scale is just enormous. Your sources mentioned, 2.49 billion YouTube users?
As of December 2024, yeah. That scale is the moat in many ways.
And Android, same idea.
Yeah. Massive user base, attracts developers. Developers build a rich app store. That rich ecosystem attracts more users.
And the market share reflects that over 70% globally.
71.42% as of November 2024, according to your sources. It's dominant. And the same logic applies to Maps, Waze, the ad network user scale, improves the service or makes the market work better.
You really see this moat in action with search market share, right? Despite big competitors like Microsoft's Bing.
Google still holds around 89.98% globally as of late 2024. It's just dominant.
And it's not just people choosing it. It's that data advantage, the AI improvement.
And user habits. It's incredibly hard for anyone else to make a dent.
Plus, it's reinforced by being the default, isn't it?
Hugely important. Chrome defaults to Google search, and Chrome has, 65% browser share?
Yeah, August 2024 number.
Android phones default to Google search. And your sources even mentioned that rumored $20 billion a year payment to Apple.
Just to stay the default on Safari.
Yeah, it shows how incredibly valuable they think that default position is. It's a massive moat defense tactic, even if it's expensive.
So how are these moats trending? Are they getting stronger, weaker?
It's a bit mixed, according to your sources. Search's moat seems stable, but it's definitely feeling the pressure from AI shifts. Still grew, though, 13.1% in 2024.
Yeah.
YouTube's moat seems to be widening with user growth. Android and Chrome, stable, given their dominant shares.
And Cloud.
Cloud's moat looks like it's widening, too. It's growing faster than the market, grabbing more share up to 12% in Q1 2025.
So that default status is key. But the big test, the elephant in the room, is generative AI.
Absolutely. That's the crucial question right now. Will AI change search habits so much that it erodes Google's moat? Or can Alphabet integrate AI so well that it actually widens the moat, making their services even stickier?
That really is the multi-billion-dollar question.
It is. Everything kind of hinges on that right now.
Okay, let's shift gears a bit. Let's look behind the scenes. What's the experience like for users and for the people actually working at Alphabet? Your sources touched on sentiment.
Yeah, customer sentiment. It's complex. Generally, it's positive, or maybe tolerant is a better word.
Tolerant because it's useful.
Exactly. Because the products are so useful, often free, and just deeply integrated into daily life. They're like utilities for billions.
Okay, but specific products. Search.
Universally used, very effective mostly. But your sources note concerns creeping in, worries about bias, maybe declining quality because of ads or SEO spam.
I've heard people mention that.
And of course, the ever-present privacy concerns about data collection.
Right. What about Gmail?
Widely used.
Right.
People like the features, the integration. But frustrations definitely exist. Lack of direct customer support is a big one mentioned in your material.
Yeah, trying to get help can be tough.
Clipped messages in the interface annoy people. And some just feel, low into this huge, dominant provider.
And YouTube.
Yeah.
Immensely popular, but
the ad load, that's a major, major pain point people mention. More and more ads.
Seems like it, yeah.
Also, the algorithm, sometimes it pushes weird stuff. Sometimes it just doesn't seem to get what you want. Plus, privacy concerns around recommendations.
Okay. Maps.
Highly valued for navigation, local info. But your sources picked up on this feeling among local guides, the users who add data, that they're doing free labor.
Interesting point.
Plus issues with fake reviews, slow corrections to map errors.
But on the business side, Google Cloud is getting positive feedback.
Yeah, particularly from businesses using their AI tools or the customer engagement suite. Your sources mention reports of improved customer satisfaction, better efficiency for those clients.
So, summarizing the customer view, essential tools, maybe more dependence than actual love.
That seems fair. And because they operate at such scale, even small flaws affect millions, potentially billions. Friction points like ad fatigue or that free labor feeling, they could make people open to alternatives down the line.
Okay. Now, what about the employees? Inside Alphabet, your sources suggested a mixed bag.
Very much a mixed bag. On one hand, they attract incredibly smart people, pay well, offer great perks, and you get to work on things that impact the whole world.
That's the allure, right?
Absolutely. But on the other hand, common negatives pop up in your sources. Bureaucracy, things moving slowly.
Big company problems.
Yeah. Cultural concerns too, maybe favoritism, lack of clear direction sometimes, work-life balance challenges, and definitely the big layoffs in early 2023.
12,000 people, right.
Yeah, that and other restructuring clearly hit morale hard, created a lot of uncertainty, especially after what the CEO called that period of dramatic growth and hiring.
Your sources even mention Glassdoor reviews, acknowledging they can be skewed, but
But also that recurring themes often point to a grain of truth about the internal culture. You can't just dismiss everything.
And this links back to the moat, doesn't it? Especially with AI.
Critically important. Innovation is key, especially now. If bureaucracy or cost-cutting stifles that innovative culture, that could really blunt their edge in the AI race.
Can those pockets of startup culture they talk about compensate?
That's the big question your sources raise. Can they maintain agility inside such a huge organization? It's directly tied to defending that external moat.
And there's that tension you mentioned, the drive for growth, leading to things like more ads.
Which can degrade the user experience. It's a delicate balancing act. Push too hard on monetization, and you risk hitting a tipping point where users start looking elsewhere.
Okay, let's pivot to the financials. Your material calls Alphabet a financial fortress. What does that actually mean in practice? How do they manage all that capital?
Well, starting with leadership. Sundar Pichai's philosophy, based on your sources, is laser-focused on AI as the future. He's called the opportunity as big as it gets.
And he's putting money where his mouth is.
Big time. Massive investments in R&D, but especially in Capex, capital expenditures.
That's the physical stuff, data centers, servers.
Exactly. And your sources show a huge surge here. Q1 2025 Capex was up 43% year over year. That's $17.2 billion in one quarter.
Wow. And the full year?
The guidance for 2025 is an absolutely massive $75 billion.
$75 billion. That's a colossal bet on AI infrastructure.
It's a defining strategic move. Alongside that, his philosophy includes innovation on big challenges, that's the other bet stuff, and focusing on efficiency. The layoffs were framed as part of that, realigning after rapid hiring.
And shareholder value seems to be getting more focused now, too.
Definitely. Your sources point to aggressive share buybacks, $70 billion authorized recently. But the really big news, the notable shift.
The dividend.
Their first ever quarterly dividend, started in Q1 2025, 71 cents per share. That's a major signal.
So how rational is all this capital allocation? Your sources seem to weigh both sides.
Yeah, the arguments for rationality are pretty strong. Investing heavily in AI feels necessary given the tech shift. Buybacks make sense if they think the stock is undervalued, returning excess cash.
And the dividend signals confidence, broadens the investor appeal.
Right. And achieving cloud profitability shows they can exercise discipline on big bets.
But what about the concerns? Empire building.
Well, the other bets consistently lose money, projected $4.4 billion loss in 2024. Your sources say those need scrutiny for a path to return. And that $75 billion Capex, it's huge, carrying execution risk.
And founder control means their long-term vision kind of overrides typical shareholder pressure.
To some extent, yes. The dual-class shares give them significant control, so their definition of rational long-term holds a lot of weight.
But that dividend is significant, isn't it? It kind of says the core ad business is so profitable.
It's a mature cash cow. It can fund this enormous AI build-out and start returning cash directly to shareholders. It definitely attracts a different kind of investor, maybe imposes some discipline.
And that $75 billion Capex, it's not just spending, it's a strategic pivot, a gamble on AI leadership.
Absolutely high stakes. And with more focus on shareholder returns, those other bets' losses might face tougher questions, even if they hold potential long-term value like Waymo or Verily.
Okay, back to the financial fortress. Let's talk numbers. Key ratios.
Right. It's an earnings machine, mainly from Google services. Consistent revenue growth, 8.7% in 2023, over $307 billion total. Massive operating income, $84.3 billion in 2023. Healthy margins, around 27.4%.
And the key quality ratio, return on invested capital, ROIC.
Consistently excellent, according to your sources, around 30%.
30%. How does that compare?
Your material cited an industry average of just 1.4%.
Wow, okay, so 30% is fantastic.
It's phenomenal. It showed strong moats and efficient use of capital. Real value creation.
And free cash flow conversion. Profit turning into actual cash.
Also strong. Your sources estimated 81-88% in 2023. That high-margin ad business really helps, although obviously that huge Capex spend eats into the immediate cash flow number. You spend billions on data centers, less cash hits a bank account that year.
Makes sense. And the balance sheet, debt levels.
This is where the fortress idea really shines. Let's break down the numbers from your sources. Total debt is about $28.5 billion. Okay, seems like a lot. But cash and securities are way higher, $113.76 billion.
So they have way more cash than debt.
Exactly. It leaves them with a net cash position of over $85 billion.
$85 billion in the bank, effectively.
Which leads to a net debt to EBITDA ratio of negative 0.90x. That negative number means net cash. It's incredibly strong.
And gives them huge flexibility.
Immense flexibility. They can fund those massive AI bets, the other bets, weather downturns, make acquisitions, all without financial strain. It's a huge advantage.
But your sources raise a subtle point. Will future ROIC stay that high?
Yeah, that's the question. As they invest more in inherently capital-heavy areas like cloud and AI infrastructure, will that dilute the overall company ROIC compared to the historically lighter search business? It's something to watch.
A very fair question, which leads us directly into risks, future growth, and that price tag discussion. What's the number one driver for future growth based on your material?
No contest. Artificial intelligence. Successful development, integration, innovation with AI across the board.
How does AI drive growth specifically?
Well, it enhances search and ads. Think AI overviews, better ad targeting. It's the key differentiator for cloud, driving that 28% growth in Q1 2025. It improves YouTube. It powers the other bets like Waymo.
It's everywhere. Pichai's focus, that $75 billion Capex, it all points to AI.
That's the priority. But that dependence also creates the biggest risks, what your sources call permanent impairment risks, long-term threats.
And the biggest one is?
Failure to navigate the AI transition in search. This is absolutely critical.
Explain that.
If AI changes user behavior away from traditional search pages, those lists of blue links we click on in Alphabet can't adapt the ad model.
The model breaks.
Potentially. If people get answers directly from AI and don't click ads, that core $200 billion search ad engine could be seriously permanently damaged. New AI interactions might just be less monetizable, or competitors could grab those interactions.
And that concern about Apple maybe using different AI in Safari.
Exactly. Losing that $20 billion a year default spot in an AI world, that would hurt. The fundamental risk boils down to, will Alphabet lose its golden goose, its cash cow?
Okay, what other major risks?
Regulation. Always a big one for them. Antitrust scrutiny is constant. Search, ads, Android, the Play Store.
Because they're so dominant.
Their market shares, 90% search, 71% Android, 65% Chrome, basically invite scrutiny. The risk isn't just fines. It's potential force changes, breakups, restrictions that could really hamstring them.
And user trust. Data access.
Another persistent threat. A major data breach. Continued negative feelings about data collection. Tougher privacy laws. Anything that undermines ad effectiveness or personalization is a risk. It's ongoing, even with things like GDPR. Future laws or incidents could still bite.
And these risks aren't isolated, are they?
No, your sources point out they're interconnected. AI struggles could be made worse by regulatory limits on data, for instance. They can compound each other.
Your sources also mention the innovator's dilemma. Can you unpack that?
It's the idea that being so successful with your current profitable model in this case, search ads makes it incredibly hard, culturally and financially, to shift decisively to something new, like AI search, especially if that new thing might be less profitable initially.
They have to be willing to cannibalize their own cash cow.
Potentially, yes. To sacrifice some short-term search profit to win the long-term AI game. That's tough for any incumbent, especially one as profitable as Google Search has been.
Okay. So bringing all this together, quality, moats, financials, risks, where does it leave the price versus value question? Using the numbers from your sources, mostly early June 2025, PE around 19.1x, PFCF around 31.0x.
Right, and comparing that PE of 19.1x to its history, it's quite a bit lower than the 5-year average, which was around 25.7x.
So cheaper than usual on an earnings basis.
Yes, but the price to free cash flow, around 31x, is actually at or maybe even a bit above its recent historical average of 25 by 30x.
Okay. So PE looks low, PFCF looks normal to high. What's the judgment from your sources?
Considering the overall quality, the strong moats, the financial power, the judgment leans towards the current PE discount, making it a potentially attractive or at least fair entry point for long-term investors.
Why that conclusion?
Because fundamentally it's still a wonderful company, as Buffett might say, strong position, very profitable. The PE discount seems to be the market pricing in those big fears. AI disruption, the hit to free cash flow from all that Capex spending, and the regulatory clouds.
So if you believe they can navigate the AI shift and keep growing cloud,
then maybe today's price doesn't fully reflect that future potential. The higher PFCF is seen partly as a result of that necessary AI investment plowing cash back into future growth.
But that's the key, isn't it? You have to believe in their AI execution.
Absolutely critical qualifier. Your sources suggest the market is in show-me mode regarding AI monetization. A PE around 19x isn't typical for a top-tier growth company unless there are significant headwinds. It reflects narrative risk.
Meaning, if they prove AI search works and monetizes well in the next year or two,
The stock could re-rate higher.
Mm.
But there's also the context of that historical PE. Was the 5-year average boosted by lower interest rates and less perceived AI threat? Maybe a lower PE is the new normal given higher Capex and competition. So whether 19x is attractive depends on your view of the future, not just the past.
Okay, let's push a bit further. Second level thinking. What might the market consensus be missing? What's a potential contrarian view here?
Well, the general market story seems to be great company, but facing a major AI threat to its search cash cow. They're spending massively in an AI arms race, maybe got caught a bit behind initially. Cloud's growing, regulation is a drag. Valuation reflects the uncertainty. That's the consensus narrative.
So what might that narrative be underestimating?
Based on your material, a contrarian might argue the market's underestimating a few things. First, Alphabet's integrated AI capability.
Meaning?
The market focuses heavily on external threats, like ChatGPT. It might be missing Google's deep internal AI talent, DeepMind, Google AI, their unique data access, and crucially, their ability to weave AI like Gemini through everything. Search, Android, YouTube, Workspace, Cloud.
That integration is the key differentiator.
It could be. It defends their existing services and creates possibilities standalone AI can't easily match. The caught flat-footed narrative might underrate this ecosystem leverage.
Okay, what else might the market underestimate?
Second, maybe the sheer stickiness of user habits and ecosystem lock-in. Billions use these tools daily. Inertia is powerful. People might prefer AI enhancing the familiar Google tools rather than switching entirely, especially if Google's AI is good enough or better integrated into their workflow.
Yeah.
That Google habit is strong.
Third point.
The long-term monetization potential beyond search ads. Maybe the market's too narrowly focused on the risk to search. AI could unlock significant new revenue. Specialized cloud AI services, premium AI subscriptions, breakthroughs in other bets like Waymo or Verily finally paying off thanks to AI advancements. The sum of the parts could be greater than expected.
Interesting. And fourth.
That massive $75 billion Capex, seen by many as just a cost drag. The contrarian view might be that it's actually strategic defensive aggression spending to build an insurmountable AI infrastructure advantage that benefits all their businesses long term. The market might be missing the moat building aspect.
So the contrarian view shifts the focus from search under threat to the whole Alphabet ecosystem being supercharged by AI.
Pretty much. AI could deepen engagement everywhere, indirectly helping search too, while also creating new premium opportunities.
And this view sees other bets differently too, not just loss centers.
Exactly. Sees them as undervalued call options on the future. AI breakthroughs actually increase the potential value of Waymo or Verily, which Alphabet structure allows it to nurture long term.
Okay, powerful contrarian points. Now let's do the red team challenge. Flip it. Argue aggressively against the bull case. What if the moats crumble? What if AI fails them?
Right. This is the AI kills the golden goose scenario. The entire investment case really hinges on search evolving without its monetization breaking.
If AI fundamentally changes how people get info, bypassing clickable links,
That $200 billion search ad model could just collapse irreversibly. AI providing direct answers is fundamentally different. If that happens, the core profit engine is gone.
and those network effects, they aren't invincible.
No moat is. They're tied to the current way people interact. If AI offers a truly step-change better experience, habits could break much faster than people think. The Google habit isn't set in stone.
And cloud, even if it grows, isn't enough to fill that hole.
Probably not. It's smaller than search, faces intense competition, and likely has lower margins than search historically did. It can't easily replace a failing search business.
What about the $75 billion Capex in this negative scenario?
That's the nightmare. It's rational spending if the premise is right. If the premise is wrong, if AI kills search ads anyway, or their AI efforts don't win, then it's just colossal capital destruction. Historical ROIC means nothing if you're pouring billions into the wrong future.
And regulatory risk could increase if they're weakened.
Potentially. Regulators might see a less dominant struggling company as an easier target for aggressive action.
So the red team conclusion is,
Investing today is very risky if the market is underestimating how quickly and deeply AI could dismantle search advertising. The valuation might look okay versus history, but it's way too high if the main profit source is permanently impaired. The wonderful company of the past might not be the wonderful company of the future if that central pillar crumbles and the replacement isn't as strong.
Wow, okay. We have really covered a huge amount of ground here. From the core business model, the moats, customer and employee views, that financial fortress, the risks, growth, valuation, and then hitting it from the contrarian and red team angles.
Yeah, we've really tried to work through the material you provided to distill it down into, hopefully, a useful framework. The key facts, the different viewpoints, the major tensions surrounding Alphabet right now.
Exactly. So for you, the listener, the next step is yours processing all this. But we want to leave you with a final thought, something to chew on based on everything we've discussed.
Yeah, think about this. Given Alphabet's incredible financial power, its world-class AI talent, its massive user base, is its biggest risk really external factors like competition or regulation? Or is the toughest challenge actually internal, the challenge of disrupting its own incredibly successful history to truly build the AI-driven future?
Or maybe frame it this way. Will that enormous $75 billion bet on AI infrastructure be remembered as the move that built the next great moat, cementing their dominance for another generation? Or will it be seen as the peak of spending right before the AI paradigm shifted in a way that made all that specific infrastructure less valuable than they hoped?
Something to definitely keep thinking about. Thanks for diving deep with us today.